There's panic in the White House as the Biden administration braces for $200 oil and economic devastation. I'm your host, Steven Van Metre, and thanks for joining me today as repeated attempts to bring inflation down has failed as oil prices remain high. And this has put the fate of the economy in the hands of the Federal Reserve, who is embarking on one of the most aggressive tightening cycles in history, which is threatening to completely crash the economy. And the White House is already concerned because their fears is oil prices are not just headed higher, but a whole lot higher. Let's start out today's story with Bloomberg, where we go backwards and give just some color to the story as the oil rally reverses amid signs of slowing gasoline demand. The West Texas Intermediate slipped under 110 a barrel after rising as high as 114 during trading on Wednesday. A government report showed that crude oil stocks fell as fuel makers increased runs amid historically high refining margins. Meanwhile, gasoline demand on a 4-week rolling average fell to the lowest seasonal level since 2014, with the exception of 2020. And the slowdown in gasoline demand growth could be a sign that prices are starting to impact consumers. Demand is currently below seasonal averages, but the thing for crude is it's still growing. And that's one of the concerns here, that demand for crude is going to continue to go higher, and that's going to take prices up with it, and of course, inflation as well. Compounding the concerns over supply tightness, OPEC Plus is expected to rubber stamp another modest supply later this week, although the cartel has struggled to meet its targets this year. The U.S. has lobbied OPEC to do this, but there's only hope that OPEC Plus will institute a further production increase. Oil is headed for the first monthly decline since November after being hit by fears of a global economic slowdown, but prices are still about 50% higher this year. It's important to understand that if the economy does enter a recession, particularly the global economy, well, demand for oil will go down with it, and that, of course, would bring inflation down, but that's not exactly what policymakers want. While fears of a global economic slowdown have weighed on futures, demand remains robust for now. U.S. retail gasoline prices remain near record highs, causing pain for consumers, leaving them with less money to spend in the broad economy. A recovery from COVID-19 and a shortage of refining capacity to make fuels continue to keep prices at record highs. And U.S. emergency oil reserve draws by 6.9 billion barrels to the lowest since 1986. And this is the big story here, because U.S. crude inventory in the Strategic Petroleum Reserve fell by 6.9 million barrels this past week, according to the Department of Energy. And stockpiles in the SPR fell to 497.9 million barrels, the lowest since April 1986. Now, this has massive repercussions, and I want you to understand why. Because Cushing storage tanks require a minimum level of oil to maintain normal operations, which traders estimate to be around 20 million barrels. And here you can see the Cushing data on inventory level, which we've looked at in the past because we've shown, and we're not going to talk about today, is there's an inverse correlation. When inventory levels rise, treasury yields fall. But notably, what we see is inventory estimates put Cushing around 21 million barrels, with, of course, the margin for error being at 20 million barrels, just above that amount, of course, threatening to put operational security at Cushing in dire situation. But what does this mean, of course, for the White House as our big story here of why is the White House concerned? Well, let's dig into that. And give us a plan or give us someone to blame inside a White House consumed by problems Biden can't fix, according to CNN. But for an administration that ended last year forecasting a leveling off of 40-year high inflation and eager to tout a historically rapid recovery from the pandemic-driven economic crisis, there's a level of frustration that comes with acutely perilous moment. Asked by CNN about progress on seemingly intractable challenge, another senior White House official responded flatly, "Which one?" Instead of managing an economy in the midst of natural rotation away from recovery into a stable period of growth, economic officials are analyzing and modeling worst-case scenarios like what the shock of gas prices hitting $200 a barrel may mean for the economy. And soaring prices, teetering poll numbers, and congressional majorities that appear to be on the brink have created no shortage of reasons for unease. Gas prices are hovering at or around $5 per gallon, plastered on signs and billboards across the country as a symbolic daily reminder of the reality, one in which the White House officials are extremely aware that the country's view of the economy is growing darker and taking Biden's political future with it. You don't have to be a very sophisticated person to know how lines of presidential approval and gas prices go historically in the United States, according to a senior White House official. And they're absolutely right. When we go back from 1977 to 2010, looking between Jimmy Carter and Barack Obama, we see the presidential approval in blue tends to fall as we see gas prices here shown inverted rise, putting actually things in a dangerous situation for the current administration. And CNN's polls average of ratings for Biden's handling the presidency finds that 39% of Americans approve of the job he's doing. His numbers on the economy, gas prices, and inflation specifically are even worse in recent polls. Biden, after months of weighing the idea, threw his support behind a federal gas tax holiday. A day later, Energy Secretary said that they're having an emergency meeting with oil and gas executives in hopes to find a way to bring prices down. Now, if you're concerned at all what a surge in oil prices could do to your portfolio and how it could lead to a massive deflationary crash, well, there's only one strategy out there that hedges with bonds, and that's Portfolio Shield. I'll put a link up here in the corner and description below, because what we're going to see in the months to come is going to do big things. Now, let's take a look at what's going on with OPEC, because they've decided to get behind this, but not as much as everyone hoped. And OPEC allies agree to boost oil production ahead of Biden's Saudi visit as producers agree to collectively raise output by 648,000 barrels a day. The increase in production levels for August matched what the broader alliance called OPEC Plus agreed on for July. Before this, OPEC Plus rolled out monthly increases of 432,000 barrels a day in production that the alliance agreed to last year as part of a plan to raise output to pre-pandemic levels. As rebuffed repeated calls from the U.S. and other major oil-consuming nations to pump more oil to help tame prices. And oil prices have surged in recent months, fueling inflation around the world, in part because several OPEC Plus members have been unable to meet their share of production as global demand has picked up. They pumped nearly 3 million barrels a day less than its collective production target of around 42 million barrels a day in May, according to an independent assessment report. The shortfall was due mainly to falling productions and sanctions in Russia, chronic output problems in Nigeria, Angola, and some other countries, according to OPEC. It is already a very difficult balancing act for us, says senior OPEC delegate. Let's say Saudi Arabia and the United Arab Emirates pump more, and considering they are the only members that can do so, we're left with barely any cushion to deal with an unexpected event in the market. And of course, this has major implications for the economy. And I want to show you now, we're going to look at some charts of how this impacts consumers and why the White House is so desperate to bring oil prices down. Because as we talked about, this is a political issue. And when consumers are faced with high inflation and their wages aren't keeping pace, there's one thing they do, and that's go to the polls. But it also has major implications for the stock market and the bond market. Let's take a look at these charts where we've got crude oil prices, West Texas Intermediate, against U.S. regular formations of gas price in red. And what do we notice? That a barrel of WTI has a big direct impact on gas prices. So as oil prices go higher, and if they were to go to $200 a barrel, that implies that gas prices could easily get upwards of $8, maybe even $9 per gallon. But notably now, let's look at how this impacts consumer price index, because we'll take West Texas Intermediate in blue and we're going to overlay the consumer price index on a year-over-year rate of change. And notice that we see that the consumer price index has a massive focus on energy. Of course, that's because crude oil and gasoline not only go into the production of goods and services, but the transportation of goods and services. So as, of course, energy prices go higher, well, consumer prices are going to go with it. And here we can see now inflation expectations of what this has to do with the consumer. Because inflation expectations have a major impact. And what you can see is as gas prices go higher, consumers, when we look at, of course, the University of Michigan inflation expectations in red overlaid, well, we see gas prices going higher, inflation expectations go higher. So now you can see why the White House is so focused on getting gas prices down, because that brings inflation expectations down, and that's the win they need to go into the midterms. And of course, what does this have to do with the equity markets? Well, now when we take West Texas Intermediate on a year year-over-year rate of change and overlay the Wilshire 5000 in red, the total U.S. stock market, on a year-over-year rate of change, what we can see is that periods where crude oil prices, again, on a year-over-year rate of change are declining, it has either means the stock market is starting to slow its growth, or it leads and oftentimes leads the equity market down. And so here we can expect that, in fact, if oil prices were to come down, whether it's due to a recession or just due to less demand or it's due to more pumping, it means equity prices are headed even lower. And what about for the bond market? Well, there's even a greater correlation now when we overlay the 30-year Treasury yield on a year-over-year rate of change against West Texas Intermediate on a year-over-year rate of change. What we can see is that crude oil goes down, interest rates go down. And there's periods where crude oil, here you can see an example, is heading lower. Rates are rising as people believe it's inflationary, and all of a sudden rates do a hard reversal. And there are some other examples as well. Here we can see crude oil trending lower, rates get shot up, and they come crashing down. Here's another example where we see crude oil starting to head lower in year-over-year rate of change, suggesting that interest rates are about to outright crash lower. And of course, if interest rates crash, that tells us that financial conditions are tight and we're likely headed into a massive recession, which will lead, of course, if we're lucky, not to another financial crisis, but the probabilities are high. And so now you know why there's panic in the White House and why lower oil prices are actually going to make things much worse. I'm your host, Steven Van Metre. Thanks for watching. Thanks for being fans. Bye now.